So are you wondering what Swiss cheese has to do with successful retirement planning and investment planning for retirement? As it turns out, it has a lot to do with it. So in this video, I'm going to talk about the inspiration behind this video and Swiss cheese. We're going to talk about the lessons we can learn from Swiss cheese and how we can apply those lessons to our own planning. And the result will be a higher probability of you achieving your retirement planning goals. So first of all, let me just share the story about where this idea came from. So I watch a YouTube channel called Pilot Debrief. I'm not a pilot, but I'm fascinated with the stories that whoever goes over. So he talks about, unfortunately, various pilot errors and tragedies that have led to crashes over time. And he's really targeting specifically to pilots and saying, listen, watch these stories, go through the debrief, learn from these experiences. It's actually really, really interesting. But he uses the example or an idea that he calls the Swiss cheese model of risk management. The Swiss cheese model illustrates risk management through multiple defense layers. And the defense layers would be layers of Swiss cheese. So originally, the Swiss cheese model was used in accident prevention. It applies to retirement investing by ensuring that no single failure can derail your financial security. So we're taking a risk management strategy planning idea and applying it to our own retirement planning and investment planning. So the way you want to approach the Swiss cheese model is, in this illustration, is a great representation. You've got different layers of Swiss cheese. Each layer represents a strategy or a defense mechanism to protect you against hazards or threats that could lead to harm. So we've got the threat or hazard here, and we've got the loss or harm. Now the idea is, if holes in the Swiss cheese line up perfectly between each of the layers, it increases the probability of a catastrophic event. And in fact, when Hoover covers off his stories in the channel, that's exactly what's happened. The airlines have all these different mechanisms, strategies, processes, procedures to make sure that crashes don't happen, and yet they still do happen. And what happens is, for whatever reason, the holes in the Swiss cheese end up lining up, and there's been some mistakes in each of these stratifications that led to harm or loss or a catastrophic event. Now, we could apply the same model to our retirement income planning. There are different strategies that we can put in place to increase the probability that you'll actually achieve your goals, that you won't run out of money or have a catastrophic event in your portfolio that will derail your planning, right? That's really why we would go through this exercise. And some of these strategies are not earth-shattering, but if you miss any of the strategies, you increase the probability that you might have some problems down the road. So we'll talk about some of the main components to the Swiss cheese model as it relates to aviation, and then we'll apply it to our own retirement income planning and portfolios. So when Hoover goes through the stories, this is what we're trying to learn from. We don't want a catastrophic event, and you do not want a catastrophic event in your retirement. You don't want your retirement to crash. Now, crash is dramatic, but what are we talking about? It could be having more life than money. It could be underperforming in terms of your portfolio. It could be life events that derail your planning. What are the life events? It could be the death of a partner. It could be separation, divorce. It could be issues with kids. There's all kinds of things that can come up. And if you have a process in place to reduce risk, it'll increase the probability that not only will you achieve your goals, but you'll get through the reality that life can be chaotic. Life will throw curveballs our way. So the reason you go through this risk management process is that it increases the probability that not only will you achieve your goals during the good times or just average times, but you'll achieve your goals during really lousy times. Now, the chart that you see on your screen is a really good example of this. It's a very simple example. I've used it before in other videos, but we've got average stock fund returns versus average stock fund investor return. So we've got the mutual funds and then we have the investors. The data is back 1992 to 2011. And what IFIC, which is a research group, did is they said, what was the average performance of the stock mutual funds over that time period? It was 8.2% compounded rates of return. What was the average return of the investors buying those funds? It was 3.5% compounded returns. So the researchers said, well, what is that difference? They referred to it as the investor behavior penalty. So there were certain behaviors that the investors were initiating that actually hurt their performance. Now we can use this in our planning as well. What behaviors do we have to be mindful of that could derail our plans, and what procedures should we put in place to make sure that that doesn't happen to us? Hence, the Swiss cheese model. So I'm going to talk about 6 factors that the Swiss cheese model needs to deal with so that you don't have a catastrophic event. So with flight, the plane's going down. So we're going to talk about specific things, 6 examples, where if you're an aviator, you want to think about these things. But you also want to think about these things from the standpoint of retirement. So I'm going to draw some parallels between each of these 6 strategies or ideas and how you can apply those same ideas to your planning. Now, the first idea is human error, which can be from stress, fatigue, poor communication, emotion, right? So when you look at that, you know right away that you could apply human error to your own financial planning, your retirement planning, your portfolio management. A lot of the decisions that we make on a regular basis are influenced by how we feel, the emotions we're experiencing, the psychology that we're experiencing. So who hasn't been anxious? Who hasn't been tired, right? Who hasn't been going through periods of stress? We all have, right? And what happens is it leads to reduced cognition. That's just the reality of what happens when we're in a real stress state. And that reduced cognition can lead to reactive decision-making and poor decision-making. That's a reality. We need to face up to that. You're not a robot, and there will be times. Maybe life is tranquil right now. Everything's going according to plan, but that won't always be the case. And so we need to acknowledge that. Secondly, we have cognitive and emotional biases. We have subconscious drivers that influence our behaviors. We think we're being rational when sometimes we're just not, but we're not aware of it. And what are those biases? Well, follow the crowd. All you have to do is just look at your social media feed. Look at the crowd following that goes on there. Look at, the influence that the media has on your behaviors, even your investment decisions. What about the markets and that information and noise that's coming your way? That will be, influence you for sure. Some people are overconfident. I'm seeing less of that at the time that we're recording this, but went through a good phase in the market, and a lot of people were pretty confident. A lot of the performance is driven by a little bit of luck and timing, but they were very confident. Now some of that confidence is gone. Loss aversion and how we weigh gain or loss are 2 critical elements. This speaks to the psychology and emotion of planning, particularly when it comes to investing. We weigh loss far more heavily than the potential of gain or real gain. Psychologists would tell us often it's a 2 to 3 to 1 ratio. So if you get 1 unit of loss, you need to get 2 to 3 units of gain or good stuff to have the same emotional equivalence, right? So as a consequence, because we have that bias, we weigh the potential for loss far more in excess of the gain, and that influences decisions and sometimes leads to bad decisions when it comes to financial planning and retirement planning. So in this video, we're going to talk about some strategies that you can put in place to overcome the fact that you're a human being and you're not a robot. Now, the next area is training deficiencies, incomplete or inadequate training. So what are some parallels? How do we take that and apply that to our finances? I think there's some natural parallels. So how do we apply that to our finances? We can see obviously the impact in aviation, but what's an impact in terms of our planning? And I'm going to give you some ideas. You might have others, but let's just brainstorm a little bit what training deficiencies look like when it comes to retirement and retirement portfolios. Now, the first training deficiency I'll talk about is CPP start date. Now, this is an interesting one. Most people, when they retire, will start Canada Pension Plan right away. And one of the reasons for that is they have an overriding drive to do that because they want to take the money and run. It doesn't mean that they're going to take it and save it. That's not usually what happens. They're going to take it and spend it, but they want to start spending now because they might die tomorrow. Now, they're making the decision based on gut feel and emotion, but not on the data. And we do that in so many areas of personal finance. It's crazy. Now, if you're healthy at 60, 65, there's a very high probability that you're going to live past average life expectancy. So because of that, you need to look at the numbers. It may not make sense for you to take Canada Pension Plan early. In fact, you might be leaving a lot of money on the table by doing so. So that's just one example. Be a little more logical and ruthless with your decision making in that area. The next area is market timing, or trying to find market timing gurus. So these are people who can read the economic tea leaves and tell you what you should be doing, both from an economic and market standpoint. Let me assure you, gurus don't truly exist. They get the call right once, and then everyone starts following them. We live in a complex world. It is impossible to be a guru and market time successfully. I have a perspective on that, but market timing and the belief that you can do that is rooted in probably a little bit of ignorance in terms of how capital markets work and just how difficult that is. Poor knowledge in how markets work. And again, there's some practical manifestations of that. So, we know that on average, the stock market's up 75% of the time, and it's down 25% of the time. Now, remember, our emotional bias is towards loss. So as a consequence, most investors do not play the laws of probability. And as a consequence, they're not able to buy on the dips. You ask any advisor in the business, what percentage of their clients are running in the office wanting to put money down on their portfolios when there's a market correction or market volatility? And they would tell you very, very few. So we know that when there are sales on assets, good quality assets in other areas of our life, we should take advantage of those sales. Why is it that when stocks that are great companies are on sale, we do the opposite, right? Most people are unable to buy on the dips. That's partly education and partly emotion. And we need to have some strategies in place to overcome those poor decisions because of training deficiencies. Another sort of analogy for training deficiencies is rules of thumb instead of solid planning. And so a lot of YouTube videos out there focus on rules of thumb. That's a great place to start, but you don't want to plan your finances around that. You need to have a customized strategy tied to your specific goals and financial circumstances, not rules of thumb. And so when you use rules of thumb, that can actually derail your planning. It's not a good idea. It's a good starting point to give you some ideas to ponder, but it's not the way that you want to be planning your retirement plan. Now, the next area is rules of thumb instead of solid planning. There are a lot of great YouTube videos on finance that talk about rules of thumb. That's a good starting point, to get you thinking about the area. But you never want to engage in rules of thumb planning when you're looking at your personal circumstances. You need to plan based on your unique objectives, your unique financial profile. You do not want to use rules of thumb. A pilot is not going to use rules of thumb. They're going to have a specific flight path. They're going to be very intentional, and you need to do that as well with your own planning. And ideally, you don't want to fly solo. So, many pilots do fly solo. There's no doubt about that. And there are some checklists and some strategies for protecting against risks when you're flying solo. But the reality is that's a higher risk activity when it comes to flight. And so the same thing applies to our personal finances. Why is that? We rationalize away issues. We may have a lack of knowledge. We might have blind spots. We may need to be held accountable. We need to be encouraged once in a while. And so if you have a co-pilot, they can help you through the rough spots. If you don't have a co-pilot and you're flying solo, that can lead to problems in your planning, in life and in finances and in flying planes. And not enough reps or experience. This is very much the case with retirement planning. Not so much the case with flying. Obviously, you're going to hire an instructor, you're going to take lessons, you're going to get your hours in, you're going to get your reps in, you're going to get better and better and better and more confident. With retirement, how often will you retire? Probably just once. So as a consequence, you're not getting a lot of reps in. What about flying a plane? Do you think flying a plane and reading about flying the plane and doing some simulations, yeah, that's very helpful, but that's not the same as real reps, actually going into plane and flying the plane. If you're just reading about it, that's going to give you some head knowledge, but it's not going to give you practical experience. And the problem with retirement and retirement investing is you don't have any reps. This is a brand new experience for you. You don't know what exactly to expect, and that can create some problems. So if you don't have enough reps, you need to work with someone who has reps. Could be a friend. Talk to people who've gone through retirement, and maybe work with a retirement planning advisor who's done lots of reps and helped hundreds of families retire. They may be able to help you deal with the fact that you have a lack of experience in the area. Now, the next area is mechanical failures. Obviously, a big deal. If you're flying someplace, you don't want to have mechanical failures, ideally. And the airline industry has done a great job of dealing with this one. And even though failures do happen, you're far safer flying than you are driving. So obviously the industry has learned things over the years. They've got a process in place to greatly reduce the risk attached to mechanical failures. So from a standpoint of risk mitigation, what do? Well, they have aircraft maintenance. And we can apply the same idea to the maintenance of our retirement plans and our retirement portfolios. So let's take a look at just a few ideas in that area. So when it comes to regular maintenance of your retirement plan, it's pretty straightforward, but you need to have a checklist and you need to apply it consistently. And if you don't apply it consistently, it can create some problems. So first, obviously, is review and update your plan. It's not one and done. You need to update it on a regular basis. Number two, on your retirement portfolio, the big change for you is that you go from an accumulation mode to a deaccumulation mode. And by necessity for most people, that means having a process in place to protect and collect profits on your retirement portfolio. Security review, that's an ongoing process. Nothing's cast in stone. Investments you pick today may have to be changed in the future. Tax planning update. Tax planning is an ongoing process. Governments are always changing this area, and you need to update your plan to reflect changes in the tax code and then model accordingly. Review goals, that's your flight plan. So you have specific goals for retirement, cash flow planning, estate planning, budgeting, and also you might have some goals specifically for your portfolio. We call it an investment policy statement. And finally, make sure you've got the next update in your calendar so it doesn't get missed. One of the problems for many people when it comes to their planning is they become disengaged, lose interest, become passive, and they don't quickly respond to changes that happen in their environment. And by having a checklist and a process in place, it reduces the chances that you're going to miss things or that you miss the opportunity of proactively adjusting your plan along the way. So having this checklist in place is really, really critical. Item number 4 in the Swiss cheese model is weather conditions, low visibility, and severe turbulence. Obviously, pilots, aviators are constantly checking the weather. It's an important part of their planning process. Now, we have turbulence as well. What is that turbulence? Well, when you think through it, good examples would be economic turbulence, stock market or investment market turbulence. It could be turbulence in our personal lives, the death of a partner, separation, divorce, problems with our kids, problems with work. There's all kinds of things that come up that create turbulence in our lives. Now, this is the real test of your plan. Your plan's easy to execute on when there's no turbulence, blue skies, limited wind speeds, and you're flying along and everything's fine. That's not real life. At some point, you're going to be hit with turbulence. And that's when your plan and your process is going to be tested. You don't know when it's going to happen. You just know it's likely to happen. So you want to plan in advance. So I'm going to give you a good example of turbulence and how to plan for it. Very simple strategy, but an important one to execute on. Now, this chart is a really good illustration of how you navigate or should navigate turbulence in your retirement planning and your retirement investment planning. So the example here is the best and worst trading days happen close together. This is the S&P 500, 1988 to 2019, and we're showing you every single trading day over that time period. Doesn't seem like there's any sort of positive movement either way. Lots of gains, lots of losses. Now, the reality is, on a net overall growth basis, the market was up over this time period. So the cumulative growth certainly was there, very good growth. But day to day, it wasn't obvious. And the other problem is the 20 best days in green and the 20 worst days in red are smacked up against each other. And that's contrary to how a lot of people think about the market. They think, market's going to go down, or I'll get ahead of it and I'll move to cash and I'll see news and the headlines and BNN and I'll be looking for good news. Eventually things will improve slowly and then I'll start putting money back on the market. That's not how it works. The good days and bad days are slapped up against each other. So if you're trying to time that, you will not time it successfully. You will maybe get it right if you're lucky, but you can't consistently execute on that strategy. And the impact over time is you're going to have less returns in your portfolio. It means less portfolio growth. It means potentially less retirement income. So you need to get this one right. You need to make sure you've got a strategy in place that helps you navigate this turbulence, which is going to be there for sure. Now, I'll talk about a strategy in a second that's very simple. The other thing is you need to be updating your plan in advance to take into account turbulence. Often when we do retirement plans, we're doing randomized return sequences, we're doing black swan events in the portfolio, and we're stress testing the portfolio and the retirement plan in advance of it happening, right? So you want to make sure you train, test to make sure your portfolio is resilient. So in this specific area, how do you plan for this? Well, you need to make sure that you are rebalancing systematically. We don't have a single client that doesn't have some portion of their portfolio where it's systematic rebalancing. We do not ask for permission. The portfolio gets rebalanced because we know that clients they're not going to come running into our office to add money to their portfolio when the market's down 10 or 15%. Yet intellectually, they know that that's a good time to buy. But again, because of behavioral finance, we know people weigh loss way more than gain. So even though the market's up 75% of the time, down 25%, people weigh that 25% way more, and it leads to poor decision making, a lack of action when they should be acting. So we just systematically rebalance to make sure that we take advantage of those opportunities, whether it's profit taking or adding money back to the market when the bargains are there. This is a really essential part of your planning process so you navigate turbulence successfully. And then if you go through turbulence, not only should you be having strategies in your portfolio, but you should be doing financial planning and you should be doing advanced modeling. Or if you go through turbulence with family, a spouse, partner, that you're modeling the implications so you can make good financial decisions so you can get through that period of turbulence. Okay, so the next piece of this model, this next piece of Swiss cheese, is airport and runway conditions, slippery, construction obstacles, poor signage. So obviously that can be a problem. And of course, the airline industry takes great pains to make sure that's not an issue. But it can lead to problems if that piece of Swiss cheese has a hole in it and it's not being dealt with properly. So what are examples in our retirement plans and our investment plans that could be the same thing? So there's probably a few examples we could come up. I'm just going to go through this chart called predictions gone wrong. Now this gets back to that idea that people have a tendency to want to follow gurus when it comes to the public markets. The reality is we live in a very complex world where predictions are very difficult to get right. But unfortunately, there's a lot of financial institutions that predict, make a lot of money on their predictions, but inevitably, more often than not, their predictions are wrong. Now, I'm going to talk about how to handle this in a minute, but we have confusing runway directions as it relates to the media, which gets things wrong consistently, as well as some of the largest investment firms out there. And I'll give you one example. So this is equity analyst predictions versus actual for the S&P 500 index calendar year returns 2024. So the S&P actually did 23.3% in 2024. The S&P 500 historical average, 12.3%. So if I look at Goldman Sachs, they were predicting much less than that. Deutsche Bank, much less. Citibank, much less. Bank of Montreal, much less. RBC Capital Markets, even less. Average analyst forecast, way below what the markets actually did. We actually had Wells Fargo, negative return forecast. Scotiabank, negative return forecast. Morgan Stanley, negative return forecast. Cantor Fitzgerald, JP Morgan. Now, this is just this 1 year, but what I can say to you is that this is a consistent theme. So for whatever reason, there's a lack of accountability. There's a lot of fees being made with this kind of information being generated, and people take action on this information. So it leads to confusing direction that can actually hurt performance. Now, I'm not going to get into in a lot of detail today. That would be another video. But the best thing you can do with your portfolio is have a plan, develop your asset mix, and then when you take investment decisions, you need to be staying fully invested and not trying to get tricky about whether to be in or out of the market because of that previous chart that I said. You want to be all in a broad market index ETF as an example, because nobody knows which investment area, which country, which market's going to give us the best performance, which stocks in any given year. What you want to do is own the broad market so that when a piece of the market gives above average performance, you're going to be there. If you start trying to be tactical about different markets, different sectors, different stocks, that's going to lead to subpar performance over time. Again, you might get lucky once in a while, right? Either because of timing or you happen to put money in the right area, but it wasn't because of your predictive ability. it was more about luck. So you want to own the broad market through securities that give you that kind of exposure, so you don't have to deal with confusing direction that can, not lead to the kind of results that you are shooting for when it comes to your retirement portfolio. Now, the last area is poor flight plan. Obviously a problem. And many of the accidents that whoever talks about, sometimes they didn't even have a flight plan. But you need to have a flight plan for your retirement. And so when we talk about flight plan, it's a financial plan or retirement income plan that is holistic in nature and takes into account a whole bunch of areas that all could have an impact on your retirement plan. So obviously retirement income planning is key, but that could actually move into areas of estate planning depending on the results of the plan. Tax planning is key, cash flow management, investment planning. You need to look at it holistically. A flight plan does that in a large extent as well, and it needs to be updated. So when you have a plan, then it's going to increase the probability that you're going to hit your destination. And if you don't have a plan, make sure you contact our office. You can find out information about how you can get your own flight plan for your retirement. And what a flight plan will do is it'll help you to identify what kinds of performance numbers you need to be driving on your portfolio to fund the flight plan, to fund the retirement plan. So again, the first document you need to put together is the retirement income plan or financial planning. That plan will define your return requirements and will define the structure of your portfolio. You don't do investment planning in a vacuum. You do it in the context of your planning so you know what the goals are, how to assess whether you're tracking in the right direction or not. Now, I'm going to talk about the importance of a co-pilot. Look at the airlines, they have co-pilots, and there's very good reason, right? So not everyone's perfect. Mistakes can happen in the cockpit. So the co-pilot can be there to recognize the mistakes been made, could be there to share tasks, could be there to offer their perspective on things. It's just a good safety valve just in case things start going wrong. So there's some obvious reasons why a co-pilot could be beneficial. Well, the same thing applies to your retirement income planning and your flight path in that area. So a co-pilot could be a spouse, partner as an example. It could be friends that you get counsel from when it comes to this area. Or a co-pilot could be a trusted advisor who specializes in retirement planning, where they help you through the planning process. They hold you accountable. They offer encouragement. They give you perspective. And they help you to recognize maybe some things that you don't recognize. You've rationalized away issues, or you're not looking at things with a broad enough purview, and they recognize where there maybe some gaps are. So because we're human and we're subject to mistakes and we're not always paying attention, a co-pilot can play a really important role in your planning process. If you're interested in finding out how you can apply this Swiss cheese risk management model to your own retirement planning, well, make sure you go to the show notes. There's a link back to our website where you can find out more information about our retirement planning services, and you can arrange a complimentary meeting. Anyway, wishing you all the best in your retirement and overall wealth planning. You take care. Bye-bye.